5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. Let me now explain the MPC's rationale for these decisions on the policy rate and the stance. Headline inflation, after reaching a low of 4.3% in May 2023, rose in June and is expected to surge during July-August, led by vegetable prices. While the vegetable price shock may reverse quickly, possible El Nino weather conditions along with global food prices need to be watched closely against the backdrop of a skewed southwest monsoon so far. These developments warrant a heightened vigil on the evolving inflation trajectory. The cumulative rate hike of 250 basis points undertaken by the MPC so far is working its way into the economy. Nevertheless, domestic economic activity is holding up well and is likely to retain its momentum despite weak external demand. Considering this confluence of factors, the MPC decided to remain watchful and evaluate the emerging situation. Consequently, the MPC decided to keep the policy repo rate unchanged at 6.5% with preparedness to act should the situation so warrant. The MPC remains resolute in its commitment to align inflation to the 4% target and anchoring of inflation expectations. Further, with monetary transmission still underway, and I have given some details in the footnote of my statement with regard to this, when I say monetary policy transmission is still underway, there are some additional information given in the footnote. Those of you who are interested may have a look at it. Further, with monetary transmission still underway and headline inflation remaining higher than the 4% target, the MPC decided to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. I would now like to provide our assessment of the growth and inflation scenario. First, I would like to take up global growth. The global economy continues to face daunting challenges of elevated inflation, high levels of debt, tight and volatile financial conditions, continuing geopolitical tensions, fragmentations, and extreme weather conditions. Belying earlier apprehensions, a number of economies have demonstrated remarkable resilience and the grim prospects of hard landing appear to have receded. Nevertheless, global growth is likely to remain low by historical standards in the current year and also in the next few years. Despite upward revision in the global growth forecast for 2023 by the International Monetary Fund. World merchandise trade volume growth is projected by the WTO to decelerate from 2.7% in 2022 to 1.7% in 2023. Headline inflation is easing unevenly across countries and remains above the target in major economies. While the pace of monetary tightening has been scaled down, policy rates could stay higher for longer. Financial markets, which had been buoyed by expectations of an early end to the cycle of monetary tightening, have turned volatile with sizable two-way movements in response to recent rating events and incoming data. Turning to global growth, these external factors are likely to impinge on the growth prospects of most advanced and emerging economies. India is, however, expected to withstand these external headwinds far better than many other countries. The momentum of overall economic activity in India continues to be positive. On the supply side, crop sowing has picked up with steady progress in the southwest monsoon. The temporal and spatial distribution of monsoon has, however, been uneven. Industrial activity is holding ground, as is evident from the latest data on Index of Industrial Production, that is IIP, Core Industries Output, and Purchasing Managers Index, that is PMI for manufacturing. Buoyant services activity is reflected in healthy expansion in e-way bills, toll collections, railway freight, and a sharp jump in services PMI. On the other hand, commercial vehicle sales and domestic air cargo traffic contracted during Q1 of the current financial year. Aggregate demand conditions continue to be buoyant. Among urban demand indicators, domestic air passenger traffic, passenger vehicle sales, and households credit are exhibiting sustained growth. In the case of rural demand, tractor and fertilizer sales improved in June, while two-wheeler sales moderated. High growth in agricultural credit and improving sales volume of major fast-moving consumer goods, that is FMCG companies, suggest incipient recovery in rural demand, which will be reinforced by improving Kharif prospects. So what I have done under growth is that first I highlighted about the supply conditions, the supply side factors, then I have highlighted the aggregate demand conditions consisting of both rural and urban demand, and let me now turn to investment activity. Investment activity gained further steam on the back of government capital expenditure, rising business optimism, and revival in private capex in certain key sectors. Continued increase in import and production of capital goods further reaffirms this trend. Construction activity also remains strong in first quarter of this year, as indicated by healthy growth in cement production and steel consumption. Capacity utilization in the manufacturing sector at 76.3% remained above the long period average, remained above the long term average of 73.7%. The total flow of resources to the commercial sector from banks and other sources taken together has increased by rupees 7.5 lakh crore during the financial year 23-24 so far, that is up to July 28th, as compared with 5.7 lakh crore a year ago. So just to repeat the figures, the flow of resources to the commercial sector in the current year so far is 7.5 lakh crore, and in the corresponding period of last year it was 5.7 lakh crore. On the downside, however, merchandise exports and non-oil, non-gold imports contracted further in June, and the growth in services exports decelerated amidst slowing external demand. Looking ahead, these underlying developments and the upcoming festival season are expected to provide support to private consumption and investment activity. The spillovers emanating from weak external demand and protracted geopolitical tensions, however, pose risks to this outlook. Taking all these factors into consideration, real GDP growth for 2023-24, that is for the current year, is projected at 6.5%, with Q1 at 8%, Q2 at 6.5%, Q3 at 6%, and Q4 at 5.7%. Real GDP growth for Q1 of next financial year, that is 24-25, is projected at 6.6%. The risks are evenly balanced. Let me now turn to inflation. The moderation in headline inflation to 4.6% in Q1 of 23-24 was in line with the projections set out in the June MPC meeting. There was pickup in headline inflation to 4.8% in June due to an upturn in food inflation. On the positive side, inflation excluding food and fuel, that is core inflation, has softened by more than 100 basis points from its recent peak in January 2023. The month of July has witnessed accentuation of food inflation, primarily on account of vegetables. The spike in tomato prices and further increase in prices of cereals and pulses have contributed to this. Consequently, a substantial increase in headline inflation would occur in the near term. Going by the past trends, vegetable prices may see a significant correction after a few months. The prospects of Kharif crops have also brightened thanks to improvement in the progress of the monsoon. Uncertainties, however, remain on domestic food price outlook due to sudden weather events and possible El Nino conditions in August and September. August and beyond. Global food prices are also exhibiting a hardening bias on renewed geopolitical tensions. Crude oil prices have firmed up in the recent weeks and its outlook is clouded by demand-supply uncertainties. Assessment of the future trajectory of inflation is a continuous process. We have a choice to modify our inflation projections in every meeting of the MPC if warranted, in the interest of better guidance, or avoid frequent changes and revise them only on fewer occasions for simplicity of presentation. Given the continuing uncertainties, our latest CPI inflation projection for 2023-24, assuming a normal monsoon, is revised to 5.4%, with Q2 at 6.2%, Q3 at 5.7%, and Q4 at 5.2%. Let me just repeat these numbers for better clarity. CPI inflation projections for 2023-24, that is for the current year, assuming a normal monsoon, as I have said, is revised to 5.4%, with Q2 at 6.2%, Q3 at 5.7%, and Q4 at 5.2%. Further, CPI inflation for first quarter of the next financial year, that is 2024-25, is projected at 5.2%. The risks are evenly balanced. Headline inflation projection for the second quarter of 23-24, that is, for the months of July, August and September this year, has been revised up substantially, primarily due to price shock from vegetables. Given the likely short-term nature of these shocks, monetary policy can look through high inflation prints caused by such shocks for some time. The frequent incidences of recurring food price shocks, however, pose a risk to anchoring of inflation expectations, which was underway and which has been underway since September 2022. The role of continued and timely supply-side interventions assumes criticality in limiting the severity and duration of such shocks. In such circumstances, it is necessary to be watchful of the emerging trends and the risks to price stability. We have to stand in readiness to go beyond keeping Arjuna's eye to deploying policy instruments if necessary. I reiterate what I said in the previous June policy statement. Bringing headline inflation within the tolerance band is not enough. We need to remain firmly focused on aligning inflation to the target of 4%. With this, I would now like to take up the liquidity and financial market conditions. The level of surplus liquidity in the system has gone up in the recent months on the back of the return of rupees 2,000 bank notes to the banking system, RBI surplus transfer to the government, pickup in government spending and capital inflows. The overall daily absorption under the liquidity adjustment facility, that is LAF, was 1.7 lakh crore in June and 1.8 lakh crore in July this year. Despite such surplus liquidity, market response to RBI's 14-day variable rate repo auctions, that is VRRR auctions, was lukewarm. Instead, banks preferred to place their surplus liquidity in the less remunerative standing deposit facility, that is SDF. Although the fine-tuning VRRR auctions of 1 to 4 days maturity during this period evoked better response from the market, this essentially, let me just read it again, although the fine-tuning VRRR auctions of 1 to 4 days maturity during this period evoked better response from the market, this essentially reflects greater risk aversion among the banks to park large funds under the main operation. In this context, it is necessary to reiterate that fine-tuning operations, that is overnight operations up to 13 days, are undertaken to deal with special or exceptional situations and cannot become a rule. In recent years, our stated stance on liquidity is to maintain adequate liquidity in the system to meet the productive requirements of the economy. Excess liquidity, on the other hand, can pose risks to price stability and also to financial stability. Hence, efficient liquidity management requires continuous assessment of the level of surplus liquidity so that additional measures are undertaken as and when necessary to impound the element of excess liquidity. Accordingly, it has been decided that with effect from the fortnight beginning August 12, scheduled banks shall maintain, I repeat, scheduled banks shall maintain an incremental cash reserve ratio, that is ICRR, of 10% on the increase in their net demand and time liabilities, that is NDTL, between May 19th and July 28th. I would like to read this sentence again so that the message gets across. It has been decided that with effect from 12th of August, scheduled banks shall maintain an incremental CRR, that is ICRR, of 10% on increase in their NDTL between May 19th and July 28th. And what I am now going to say is equally important. This measure is intended to absorb the surplus liquidity generated by various factors referred to earlier, including the return of rupees 2000 notes to the banking system. This is purely a temporary measure for managing the liquidity overhang. Even after this temporary impounding, there will be adequate liquidity in the system to meet the credit needs of the economy. We have reviewed the position, and on that basis alone, on the basis of our internal assessment, I am making this statement that even after this temporary impounding, there will be adequate liquidity in the system to meet the credit needs of the economy. The incremental CRR will be reviewed on 8th September or earlier with a view to returning the impounded funds to the banking system ahead of the festival season. I must add that the existing cash reserve ratio, that is CRR, remains unchanged at 4.5%. I would now like to focus on financial stability. The Indian financial sector has been stable and resilient as reflected in sustained growth in bank credit, low levels of non-performing assets, and adequate capital and liquidity buffers. Macro stress tests for credit risk reveal that scheduled commercial banks would be able to comply with the minimum capital requirements even under severe stress scenarios. There is, however, no room for complacency because it is during tranquil and good times that vulnerabilities may creep in. Hence, buffers are best built up during these periods. A stable financial system is a prerequisite for price stability and sustained growth. This is a shared responsibility in which regulated entities like banks, NBFCs and others are important stakeholders. On its part, the Reserve Bank remains steadfast in its commitment to safeguard the financial system from the emerging and potential challenges. We expect the same from the regulated entities also. As regards the external sector, India's current account deficit was contained at 2% of GDP in 2022-23 as compared with 1.2% in 2021-22. Merchandise trade deficit has narrowed in the first quarter of the current financial year, that is 23-24, with contraction in imports exceeding contraction in exports. Services exports and remittances are, however, expected to provide cushion to the current account deficit. We therefore expect the current account deficit to remain eminently manageable during the current financial year also. On the financing side, foreign portfolio investment, that is FPI flows, have remained buoyant in 2023-24, that is in the current year so far. Net FPI inflows have been US $20.1 billion up to August 8, which is the highest since 2014-15. In the corresponding period of the previous year, there were net outflows of $12.6 billion US dollars. The inflows under external commercial borrowings also witnessed a turnaround with net inflows of $6 billion US dollars during April-June this year, as against net outflows of $2.9 billion US dollars a year ago. Net foreign direct investment, that is net FDI flows to India, on the other hand, fell to $5.5 billion during April-May 2023 from $10.6 billion a year ago, reflecting a global slowdown in FDI inflows or in FDI flows. Latest available data suggest that India's external debt to GDP ratio improved to 18.9% at the end of March 23 from 20% at the end of March 2022. The Indian rupee has remained stable since January 2023. Foreign exchange reserves have crossed the mark of US 600 billion. The umbrella has gathered strength, and I am not saying this in the context of the monsoon rains. I would now like to proceed and announce certain additional measures. As you would be aware, we announced several measures as a part of the MPC statement, and a number of these measures have very far-reaching consequences, and they make a lot of impact on our overall financial inclusion, on our financial, on deepening of credit, on the spread of UPI, and on other aspects of the economy. So we have a few measures. I request your continued patience. The first announcement relates to review of regulatory framework for financial benchmark administrators. It has been decided to revise the extant regulations issued in June 2019 and put in place a comprehensive risk-based framework for administration of financial benchmarks. This will cover all benchmarks related to foreign exchange, interest rates, money markets, and government securities. The revised directions will provide greater assurance about the accuracy and integrity of the financial benchmarks. The next announcement relates to review of regulatory framework for infrastructure debt fund NBFCs, that is IDF NBFCs. At present, infrastructure debt funds provide refinancing facilities for lenders in the infrastructure sector. The extant regulatory framework for IDFs has been revised. The key changes in the revised framework are: 1. Withdrawal of the requirement to have a sponsor for the IDFs. 2. Allowing IDFs to finance toll operate transfer, that is TOT projects, as direct lenders. 3. Permitting IDFs to raise funds through ECBs. And 4. Making tripartite agreements optional for PPP projects. These changes are expected to further augment the capacity for infrastructure financing in the country. The next announcement relates to greater transparency in interest rate reset of equated monthly installments based floating rate loans. Now let me just read it again, I think that was too long. It basically, the next announcement relates to bringing in greater transparency in interest rate reset of EMI installment based floating interest loans. It is proposed to put in place a transparent framework for reset of interest rates on floating interest loans. The framework will require regulated entities to, again there are various components, it will require the regulated entities to, number 1, clearly communicate with borrowers for resetting the tenor and or the EMI. Number 2, provide options for switching to fixed rate loans or foreclosure of loans. 3, disclose various charges incidental to the exercise of the options. And 4, ensure proper communication of key information to the borrowers. These measures will further strengthen consumer protection. The next announcement relates to consolidation and harmonization of instructions for supervisory data submission. The Reserve Bank has from time to time issued several guidelines on submission of supervisory returns by the supervised entities. It has been decided to consolidate and harmonize such guidelines into a single master direction to reduce compliance burden and to promote greater ease of doing business for supervised entities. And the next announcement, actually there are 3 announcements within this announcement, and it relates to UPI. And basically the announcements are related to bringing in conversational payments and offline capacity on the UPI, enhancement in transaction limit of small value offline digital payments. The details are as follows. With the objective of harnessing new technologies for enhancing the digital payments experience for users, it is proposed to, number 1, enable conversational payments on UPI, which will enable the users to engage in conversation with artificial intelligence powered systems to make payments. Number 2, introduce offline payments on UPI using near field communication technology through UPI Lite on device wallet. And number 3, enhance the transaction limit for small value digital payments in offline mode from rupees 200 to rupees 500 within the overall limit of rupees 2000 per payment instrument. These initiatives will further deepen the reach and use of digital payments in the country. And this is the final announcement, the next one, and it's really impactful. We expect this announcement going forward will have a huge impact on our credit sector. The Reserve Bank, in association with the Reserve Bank Innovation Hub, started a pilot project in September last year for frictionless credit delivery through end-to-end digital processes, starting with Kisan Credit Card loans, that is KCC loans. The pilot for KCC loans is currently operational in select districts of Madhya Pradesh, Tamil Nadu, Karnataka, UP and Maharashtra. Recently, dairy loans have been included in the pilot project in select districts of Gujarat. Based on the learnings from the pilots and to expand the scope of end-to-end digital lending processes, a public tech platform for frictionless credit delivery. I repeat, a public tech platform for frictionless credit delivery is being developed by the Reserve Bank Innovation Hub. The platform is intended to be rolled out as a pilot project in a calibrated manner. It will have an open architecture and open application programming interface, that is API and standards, to which all financial sector players can connect seamlessly. This initiative will accelerate the penetration of credit to the hitherto underserved regions and further deepen financial inclusion in our country. Let me now conclude. We have made good progress in sustaining India's growth momentum. While inflation has moderated, the job is still not done. Inflationary risks persist amidst volatile international food and energy prices, lingering geopolitical tensions, and weather-related uncertainties. In charting the course of monetary policy, we continuously assess the impact of our past actions, the evolving inflation dynamics, and the implications of the incoming data for the economic outlook. I reiterate our commitment to align CPI inflation to the 4% target on a durable basis. We do look through idiosyncratic shocks, but if such idiosyncrasies show signs of persistence, we have to act. As we prepare to celebrate the Independence Day, the air is filled with hope and promise. Let me end by recalling the prophetic words of Mahatma Gandhi, and it is as follows. I have no doubt that our country would rise to the greatest height among the nations of the world. Thank you. Namaskar.